Hello, everyone. I am pleased to welcome you to this webcast that will cover two updated sections in the third edition of the IFRS for SMEs Accounting Standard. Section 9, Consolidated and Separate Financial Statements, and Section 15, Joint Arrangements. We are looking at Sections 9 and 15 together because there is a link between joint control in Section 15 and control in Section 9. In the first part of the webcast, we'll explore Section 9 of the Standard, which has been updated to align with IFRS 10 Consolidated Financial Statements. In exploring Section 9, we'll look at the changes in this section of the Standard, including the new definition of control. Then we'll explore how to make the control assessment, which is the core part of Section 9. After that, we will cover the requirements for situations when a parent loses control of a subsidiary, the new disclosure requirements, and the transition requirements that relate to the updated Section 9. Before we dive into each of the changes to Section 9 individually, let me give an overview of those changes. Section 9 has been amended to reflect improvements made to IFRS 10 Consolidated Financial Statements. IFRS 10 moved to a single control model, providing users with more comparable, consistent, and useful information. In applying the alignment approach, the IASB updated the definition of control, which is now the single basis for consolidation, and introduced requirements for situations where a parent loses control of a subsidiary. A consequence of the move to the single control model is that specific requirements for special purpose entities are no longer required in Section 9. Applying a single control model removes uncertainty for SMEs about which requirements in Section 9 apply to various investees. Finally, the IASB retained the rebuttable presumption in Section 9 to simplify the control model. We'll focus on these changes in the next few slides. Let's start with the definition of control. Section 9 requires an investor, regardless of the nature of its involvement with the investee, to determine if it is a parent by assessing whether it controls an investee. An investor controls an investee if the investor has all of the following: power over the investee, exposure or rights to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor's returns. An investee that is controlled by the investor is a subsidiary of the investor, and the investor is a parent of the subsidiary. Let's now look at the elements of the definition of control a little more closely, starting with the element power. An investor has power over an investee when the investor has existing rights that give it the current ability to direct the relevant activities. Relevant activities are those activities that significantly affect the investee's returns. For example, selling and purchasing goods or services, and selecting, acquiring, or disposing of assets. Relevant activities will differ from entity to entity. The next element is returns. An investor is exposed or has rights to variable returns from its involvement with the investee when the investor's returns have the potential to vary depending on the investee's performance. That is, the returns are not fixed. The last element is the link between power and returns. The investor must have the ability to use its power to affect its returns from its involvement with the investee. Applying the definition of control can in some situations involve judgment. To simplify the application of the control model, the IASB retained the rebuttable presumption in paragraph 9.5 of Section 9. What is the rebuttable presumption? Control is presumed to exist when the investor owns, directly or indirectly through subsidiaries, a majority of the voting rights of the investee. This presumption, however, can be rebutted if it can be clearly demonstrated that the investor does not have one or more of the elements of control. An example of when the rebuttable presumption might be rebutted is if an investor owns a majority of the voting rights, but another entity has a contractual arrangement that gives it the current ability to direct the relevant activities. Let's look at how to apply the control model using this decision tree. The first question in the decision tree is whether the investor owns, directly or indirectly through subsidiaries, the majority of the voting rights of an investee. If the answer is no, then the next question is whether the investor has all the elements of control in paragraph 9.4b, which we discussed on the previous slide. That is, power, exposure of rights to variable returns from its involvement with the investee, and the ability to use its power to affect returns. If the investor does not have all the elements of control, then the investor does not control the investee. If the investor has all the elements of control, then the investor controls the investee. Let's go back to the initial question. That is, whether the investor owns, directly or indirectly through subsidiaries, the majority of the voting rights of an investee. If the answer is yes, the next question is whether the investor chooses to rebut the presumption in paragraph 9.5. As we covered in the previous slide, this presumption is that control exists when the investor owns, directly or indirectly through subsidiaries, a majority of the voting rights of the investee. If the investor does not rebut the presumption, the investor controls the investee. If the investor rebuts the presumption, the investor does not control the investee. The next change we are going to look at relates to the requirements introduced when a parent loses control of a subsidiary. At the date control is lost, a parent that loses control of a subsidiary derecognizes the carrying amounts of assets and liabilities of the former subsidiary and associated non-controlling interests, recognizes the fair value of the consideration received and the fair value of interest retained in the former subsidiary, if any, and recognizes any resulting gain or loss in profit or loss. There are some new disclosure requirements when a parent loses control of a subsidiary that will be covered in the next slide. Now, on to disclosure requirements. The standard requires disclosure about judgments made when applying the accounting policies that have the most significant effect on the amount recognized in the financial statements. Such judgments might include those made in determining that one entity controls another entity. Losing control of a subsidiary is a significant economic event, and the disclosure of the resulting gain or loss provides users with the disaggregated information about the gain or loss that is presented in profit or loss. Now that we have covered the main changes to Section 9, let us look at the transition requirements. That is, what happens when an SME applies the third edition of the standard for the first time. The amendments are applied retrospectively. That is, they are applied as if they have always been effective. Now, this can be tricky, so there are some reliefs. If applying Section 9 results in either consolidating an investee that was not previously consolidated, or in ceasing to consolidate an investee that was once consolidated, the Section 9 requirements are applied retrospectively. If it is impracticable to make these adjustments, the adjustments should be made from the earliest period when it becomes practicable to do so. No adjustment is required if there is no change for the investee being consolidated by the entity. Neither is any adjustment required if the entity lost control of a subsidiary before the date of initial application. Module 9, Consolidated and Separate Financial Statements, which supports Section 9, provides detailed explanations and examples relating to the requirements and is available on the IFRS Foundation's website. We are now going to look at Section 15, which has been updated to take account of a few aspects of IFRS 11, joint arrangements. Please note, however, that Section 15 does not align fully with IFRS 11. We'll start with an overview of Section 15, including the new definition of joint control. Then we will talk about the requirements for a party to a joint arrangement that does not have joint control. We will then conclude with the transition requirements. Let's review the changes to Section 15. The IASB updated the definition of joint control so that it aligns with the definition of control. The IASB also introduced requirements for a party to a jointly controlled operation or a party to a jointly controlled asset that does not have joint control. The party without joint control is an investor in a joint arrangement that is jointly controlled by other investors. What is important to note is that the IASB retained the classification of joint arrangements. Joint arrangements are jointly controlled operations, jointly controlled assets, and jointly controlled entities. We'll take a closer look at the changes to Section 15 in the next few slides. Let's look at the definition of joint control, which has been updated to be the same as the definition in IFRS 11. Just as the IFRS 10 definition of control and the IFRS 11 definition of joint control work together, so do the Section 9 definition of control and the Section 15 definition of joint control. Joint control exists only when there is an arrangement in which two or more parties have joint control. That is a joint arrangement. An entity first assesses whether the contractual arrangement gives all the parties or a group of the parties collective control of the arrangement. All the parties or a group of the parties control the arrangement collectively when they must act together to direct the activities that significantly affect the returns of the arrangement, that is, the relevant activities. Once it has been established that all the parties or a group of the parties control the arrangement collectively, joint control will be deemed to exist only when decisions about the relevant activities require the unanimous consent of the parties that control the arrangement collectively. As I mentioned earlier, the IASB retained the three classifications of joint arrangements. A jointly controlled operation uses assets and other resources of the parties to the joint arrangement instead of establishing a separate structure from the parties. A jointly controlled asset is jointly controlled by the parties and was contributed to or purchased for the purposes of the joint arrangement. And a jointly controlled entity is a corporation, partnership, or other entity in which each party has an interest. For these classifications of joint arrangements, the recognition, measurement, and disclosure requirements have not changed in Section 15. Let's have a look at the requirements for a party to a joint arrangement that does not have joint control. For jointly controlled entities, a party without joint control accounts for its investment applying Section 11 financial instruments if the investment is a financial instrument, or Section 14 investments in associates if the party has an investment in an entity over which it has significant influence. For jointly controlled operations, a party without joint control accounts for its interest in the same way as a party with joint control. This means recognizing assets it controls, liabilities it incurs, expenses it incurs, and its share of revenues. For jointly controlled assets, a party that does not have joint control accounts for its interests the same way as a party with joint control. This means recognizing its share of the jointly controlled assets, liabilities, revenues, and expenses, and any liabilities and expenses it incurred. Let us turn now to the transition requirements. That is, what happens when an SME applies the third edition of the standard for the first time. The amendments are applied retrospectively, meaning that an SME applies the amendments as if they have always been effective, with some relief available relating to the disclosures. Module 15, Joint Arrangements, which supports Section 15, provides detailed explanations and examples relating to the requirements and is available on the IFRS Foundation's website. Let's look at what other resources are available to support an SME's transition to the third edition of the standard. The IASB published a project summary and feedback statement and effects analysis alongside the third edition of the standard. It has also published a version of the standard showing changes since the second edition. The IASB technical staff is also updating the educational modules, prioritizing the sections with significant changes. These modules provide support to anyone learning about or applying the standard. Quarterly newsletters and a podcast series dedicated to the standard are also available. The newsletter summarizes news, events, and other information related to the standard. The podcast offers bite-sized insights to support implementation. Finally, you can submit implementation questions about the standard at any time using the link on the Supporting Implementation page on the IFRS Foundation's website. And with that, we have reached the end of this webcast. Until the next webcast, thank you very much for watching and listening. Bye.